Welcome to this week's edition of the 6-5 podcast. I'm your host today, co-host you may say, or host with the most. Oh God, that still sounds dumb. Daniel Newman, a principal analyst and founding partner at Futurum Research, joined by my always fun and esteemed colleague and co-host and competitor, but not really, Mr. Patrick Moorhead of Moor Insights Strategy. Patrick, how are you doing today?
I'm doing great, and thank you for calling me like funny, because nobody else I think thinks I'm actually funny or fun to be around. So introduce me everywhere we go from now on.
Yeah, you know what? When you're a tech dork like I am, and you get to hop on and talk tech with another tech dork, you can have a whole lot of fun. So yes, for everybody out there that is part of our awesome community of 6-5 listeners, Patrick and I don't only do this because it's a great job that helps us build wonderful companies, both of our respectively, but we also really genuinely love the technology, and hopefully you out there listening to us can sense that and hear that when you listen to us talk about all these different topics. Now, let me get the everyday stuff out of the way. This show for information and entertainment purposes only. And while we will be talking about a number of publicly traded companies, and we even discuss the stocks, earnings, and performance of these companies, this show is in no way intended to be the providing of investment advice. Do not see what Pat's doing. If you're watching the video, now that we're doing this on video, do not make any investment decisions because of anything we say here. However, the 6-5 is all about 6 hand-picked topics. It's deep analysis. We try to keep it news light. We try not to tell you the stuff that everybody else is already telling you. We try to tell you what it means. So that's why you subscribe and become part of our 6-5 family here, is because Pat and I try to go deeper, and hopefully we will do that today. Patrick, it's getting a little better. It's crazy. The world's crazy. But I feel like you and I could be getting on an airplane. I was actually asked this by somebody today. I don't know you, or you might have been by the same person.
I may have received that text too.
And they asked, what date? What did you say? What date do you think you'll be getting on an airplane going to an event?
I actually didn't answer yet. I've been so busy that I haven't gotten back to that person. But can you get back to them and just tell them that Pat agrees too?
Oh, all right, on it. I said October, and I think it's going to be a couple of very small analyst type gatherings. I don't think they're going to be big events.
Yeah.
But my friend, I'm telling you, I'm going to put the mask on. I'm going to keep myself safe. I'm going to keep everyone else safe. I'm getting back to life, though. Getting back to life safely. I hope everybody out there is staying safe and staying within whatever level of comfort they have. We're not here to tell you what to think. Pat and I, we like to opine, but we are certainly not here to tell you what you think. But I do hope, whether it's vacations or work trips or just going in the office and spending time with friends and family, that everybody does get to do that soon. So stay safe out there. Now that stuff is all out of the way, let's talk about our 6 handpicked topics today, because we got a great show. I'm going to jump into the first one, Pat. Cisco late last week announced that it was making an acquisition. Now, Cisco makes lots of acquisitions, but this particular acquisition was a company called Thousand Eyes. Thousand Eyes, San Francisco-based company. They're an intelligence and internet and cloud intelligence platform. Basically, as business has moved into more cloud and SaaS-based work, the opportunity to simplify the management of all those applications has become more complex. So Thousand Eyes is a technology that basically pairs very nicely with Cisco's current network topology. I mean, Cisco is a network company, and if you had an on-prem delivery of application services on your own network, there was a lot of tools and tech in the Cisco cupboard to manage that. When a big chunk of your work stream and tools start to go into the cloud, start to become SaaS delivered, the intelligence and the ability to manage that becomes more complex. And so that's really what the Thousand Eyes acquisition for Cisco was it was to expand Cisco's capability for its current customer base that runs on Cisco's network. And Cisco is one of the largest network providers in the world, to utilize its tools, utilize its software and the technology to better manage the quality of delivery of applications to both internal and external resources. To me, it was really a no-brainer. Now, the number, Pat, came in at around $1 billion. We don't know a lot about the company. It's not a big publicly traded company, not a lot of data on customers. But the one thing I'll say from an analyst standpoint is Cisco has been very fluid at making small but meaningful little acquisitions that enhance its portfolio. And this fits nicely into its the family with Meraki, with App Dynamics, and now Thousand Eyes as sort of being, this network services, software driven, recurring revenue, which is an area that Cisco really needs to go in. So my early analysis of the situation was it was a good move, a sound move. And it's great to see companies, we've seen a little bit with NVIDIA, and we've seen a little bit with a few companies, Intel, but it's good to see tech continuing to make investments and acquisitions, even though we're in sort of this strange period of time.
Yeah, it's an interesting acquisition, Daniel. I appreciated the good analysis there. I'm going to take a little bit of a different tack on the acquisition. Not that it's distinctly different from what you talked about, but it's really more of a kind of a premonition here. So this whole notion of multi-cloud is really just a buzzword until you can figure out the security and the networking. And to go truly multi-cloud, you have to know how applications are doing. And what Thousand Eyes does right now is they essentially monitor and manage network and application performance and give really good visibility. And the only way you can really do multi-cloud is to really understand how is an application running on a certain cloud, and to know when to shift it over to another cloud. And that can be from on-prem to public cloud. It can be from public cloud to public cloud. It could potentially be public cloud to private cloud. And this to me is one puzzle piece to be able to do that.
Yeah, I don't think that was a debate. I think that's adding color, man. That's good stuff. And you make a great point. We have a world that's largely hybrid. Our future is largely hybrid, and hybrid isn't just hybrid like one cloud and one on-prem. You're talking multiple on-prem, multiple edge, multiple clouds. And you have apps that are going to be delivered and experiences that will be delivered from each or any of those places. And the ability to have visibility into the quality that an app is delivered, whether that's how Netflix is being delivered on an end user's device, all the way to how your instance of SAP or Salesforce is working within your offices. More visibility is going to be important. And because of the way architectures are being designed, having that tool that lets IT leaders know how their businesses applications are performing is going to be very important. So the premonition here is sound, and I think that it's a good one for Cisco. We'll have to see over the next few quarters how integration goes, how uptake goes. We'll be listening to future earnings calls to see how our customers, are they adopting the technology? Has it been a winner for Cisco? But based on Cisco's rich history as a networking company, it seems like a logical progression for the organization. Pat, I'll let you go to the next one. I had the chance to wrap for 10 minutes on Yahoo Finance last week about Dell's earnings. So you've heard my take, but you know what? Because we like to mix it up on this show, why don't you go first? Let's hear your take.
Yeah, I love what Paul Gillen, his headline of his article, it says, "What recession? Dell VMware vaporize Wall Street earnings estimates." And I loved it because not just because it's over the top, but it was actually true. I don't think anybody expected Dell to come in and literally vaporize revenue and EPS estimates. And it's so funny how it's so easy to be smart when you go back and you look at what the fundamentals were. We were in the middle of COVID, and they have a very large PC business and a very well, and I might say, well, technically it is one of the largest supply chains in tech on the planet. And in the good old days, back when it was, you want to buy a Dell, dude, that was their thing. They had the best supply chain, the deepest supply chain, shrewd negotiators, and they were able to deliver when other companies weren't. We saw HPE earnings talked distinctly about the inability to get parts in there. And PCs were up, not just because people could get parts, but it's things that end users actually needed. The shelves were bare out there in the channel, in the commercial channel and the consumer channel. So wherever you could buy a PC, people were clamoring to get that. Infrastructure was down, but it wasn't down nearly as much as everybody else. It was down around 9%. If I compare it to Cisco was down 15%. And if I look at HPE, their compute was down 20%. So, it was down, but not nearly as down as everybody else. In fact, the only person that was up in infrastructure was IBM. They actually had growth. It was distinctly connected to the Z15. And then to tack onto that, you had VMware, who was doing an incredible amount of security licensing to folks who had to deploy client computing outside of the enterprise, and VDI and SDI solutions with things like vSAN. They really did a great job. So Dell literally vaporized their quarter. What's your take, Daniel?
Yeah, I think you hit on a lot of the key points. I think we knew the work from home thing was going to be a success. And we'll talk about HP's earnings later. We knew that basically if a company had the ability to deliver PCs, there was a buyer for them. So we expected the enterprise or the commercial client business to be good, and it was. VMware was rock solid. VMware was a rock solid part of the business. It's been one of the best investments Michael Dell has made, and it will continue to be. Double-digit growth in any environment. And right now, with what we talked about with Cisco, the multi-cloud space and the familiarity of the VMware platform to CIOs around the world basically is providing the company one of the most low hanging fruit in terms of moving their customers from VMware's virtualization technologies to VMware for hybrid and multi-cloud. And you're seeing that in the growth. That doesn't take away from the fact that companies continue to develop good products, services, licensing models, and business. It's just familiarity is important. The reason AWS has been so sticky and other cloud providers that have come out with new solutions have struggled to win in IaaS is because AWS built a dependable, reliable platform that their architects and network builders knew how to deploy. So this is very similar with VMware. People that knew how to use it, understand how to scale it. And with things like Tanzu, they're doing this at scale, and they're becoming a really important part of this multi-cloud story. So that's where you're seeing the growth from. The other side of this, the whole thing, the negative numbers, market share is Dell's thing. Market share is what they're looking for. And I believe in a couple of their key areas like servers, even though the TAM got smaller, Dell still expects to take market share. And that's a really important thing to watch because we've been dealing with not just a quarter of COVID, but we're actually dealing with multiple periods, Pat, of pullback due to China and complexities and trade agreements. So I'm looking at Dell and saying, as the economy recovers and enterprise IT spend goes up, assuming it will, and I think we both believe it will, Dell's market share is sort of the number I'm paying a lot of attention to. So the decreases in enterprise numbers are something to pay attention to and something investors need to think about. But I would actually say the fact that continued gains in market share in enterprise and key enterprise areas like server is an indicator that the company is still winning important battles and is in a good position coming forward. So a good quarter for Dell, a couple of very strong areas, a couple of areas that should see improvement as economic conditions do get better. One last little point, I know I'm going on a little bit here, but I think is important is there were a couple of pullbacks on like benefits, 401ks. The company is getting a little more conservative. It slowed down its payment of the EMC debt and actually took on some additional debt during this period of time to provide liquidity, which I think is a good decision. I think the 401k is always hard because Dell is one of those companies that likes to be known for culture. And when you take stuff away like that, it's never a great thing for building culture. But Jeff Clark was very forward that the anticipated time of returning all those benefits is the beginning of next year. And I think it was totally precautionary. The numbers did not really require it. But if I was an employee at a company, I would actually say, I'm glad my company is taking steps to make sure that we're not only here for the next 6 months, but we're here for the next 20 years. And I think most of the indicators I got from the listening to the earnings call was the company is taking those types of steps. So let's jump on to the third topic, Patrick, and let's talk about another set of earnings, but not really so much even about the earnings. A bigger story brewing in the work from home world of infrastructure was Pure Storage. Well, again, these enterprise companies with big infrastructure took hits. Pure Storage had a darn good quarter.
Yeah, they did. I had the chance to talk to CEO Charlie Giancarlo right after they posted, and we had a great conversation to get a little bit under the numbers. And what he talked a lot about was their movement to as a service, as we've talked about a lot on this show. And he really wanted to point out and say, hey, Pat, check this out. So Pure as a service is essentially a multi-cloud consumption model that can go across all of the top clouds, and you can manage your storage as if it's on-prem. Does that sound familiar? Absolutely. And their numbers are just rocking. I mean, subscriptions were up 37% overall. And the second part is Daniel, we looked at all the infrastructure players except for IBM, who had their revenue had gone down. Pure overall actually went up 12%. So them and IBM were the only two infrastructure players to show growth. Now, IBM's was a little lumpy and is a little lumpy. They can be down 20% and up 20% because a lot of it is driven by the cycle of mainframes, but Pure just keeps cranking it out. And part of the reason, by the way, they're not profitable, but their gross margins are 70%, which means they're spending an incredible amount of money on R&D, and they also spend a lot on marketing, is really the focus on an experience. I mean, this company has satisfaction ratings that rival most smartphone makers and is absolutely incredible. And if you talk to a Pure customer, which I had the pleasure of doing when they had their conference here in Austin, Texas at the convention center, they talk about this stuff just works. It's easy. So I find it fascinating that they're one of the first on-prem companies to truly deliver a cloud experience, and I think they're being rewarded for it in terms of sales growth. And I know their detractors go after them because they're not profitable, but let's not forget how long was Amazon unprofitable before it became the most valuable company on the planet. What they keep doing is pouring more and more of their operating income into R&D. And I love their model. I mean, they shake up an industry that has consolidated a bunch, and they're growing, and most others aren't.
Yeah, Pat, you really caught my sentiment. I love the focus on experience. I think the lack in a lot of B2B businesses of real focus on things like CSAT scores, like real customer satisfaction scores, is absent, and a lot of businesses will tell you that in the experiences they have when they deal with companies. So that's a real differentiator. I think another thing to point out is the real flexibility for a company like Pure in a cloud first work from home world. The disruption of its business was negligible compared to companies providing big iron. And so, yeah, you mentioned IBM earlier as the one company, but like you said, those cycles, those things were sold long before that quarter, that quarter ever took place. With Pure, the incremental business growth is much more favorable, and it actually links right nicely into the next company I want to touch on here, which is Salesforce. So, another company. So I'll just leave the Pure thing with their business model is very good for what we're going through in the world right now. And not only is the business model of the product good, but the priorities of the business is good as well. And that's part of why the company is having success. But Salesforce reported too. And, Pat, I got to say, with less travel and events, it feels like there's been less announcement. So hopefully these next coming shows will have more like, product launch and stuff to analyze. I feel like we're doing a lot of earnings, and trust me, I love doing TV and doing media quotes for earnings, but it does feel like we've been a little earnings heavy lately. So just for everyone out there, bear with us. As new tech starts launching again, I promise you, we'll be talking about it. But the company had a really good quarter. Year over year, 30% growth for Salesforce yet again. The company did take a bit of a hit. It was a little bit soft on guidance. I was kind of going through this, and I don't think we have to spend a ton of time on it, but what we just talked about, Pat, with Pure is really the story behind Salesforce. So while, yes, there are industries contracting and there are industries struggling, but there were a couple of factors that I weighed in. I talked to Business Insider about this, Pat, was that one is while Sales Cloud slowed down a little bit, the Service Cloud actually, for the first time, usurped Sales Cloud revenue. This happened this quarter. Why is that interesting? Well, in the middle of a pandemic, as companies were slowing down sales efforts collectively, the need to provide best-in-class service to customers became imminently more important. So customers upped their investment in Service Cloud in a big way this last quarter. Also, the fact that Salesforce is largely able to be consumed in cloud made the deployments and new purchases much easier for businesses to continue forward. So, and again, while there is a fraction of industries, 10, 20% of businesses that are in really bad shape, a lot of businesses were doing great. Companies were expanding quickly. Amazon added 6 figures worth of employees throughout the quarter, but not just Amazon. A lot of big tech, a lot of big e-commerce businesses expanded very rapidly throughout this period, and SaaS software was a quick option for supplying support to these businesses, and it could be stood up without any touch. And being able to stand something up in a cloud without any touch is the beauty of SaaS, like we just talked about with Pure. Going forward, there's a little bit of softness. The company does anticipate this may slow a little bit, but still a very, very strong year overall. One of the leading indicators that I'm talking about watching is one of Salesforce's lesser watched businesses, but it's their marketing cloud business. Companies are dealing with all this basically these challenges that are going on in our global world right now. Companies really have to figure out how to market to consumers again, and how to market in a post-COVID world, how to market, with all of this challenges in the global sphere, global economics, U.S. issues. They're going to have to figure out how to get messages out, and marketing will be something that needs investment. And Salesforce has a significant marketing cloud that tends to be a smaller faction. I'm watching to see, Pat, if customers start spending money on marketing again. So that's kind of my take on Salesforce, Pat. I know you didn't have a ton of time to look into this one, but anything tickle your fancy?
Yeah, I'm always keeping a track of how Tableau and MuleSoft are doing. And I really believe, and by the way, I can be proven otherwise, but I really see Salesforce as an acquire to innovate company. I haven't seen a whole lot of organic innovation, and I'm really interested to see what they do with the 2 companies that they acquired. And the second reason I'm interested there is their operating model. Tableau and MuleSoft were both hybrid companies, and Salesforce, and you can hear Benioff talk about it all the time, is he was a web first and cloud only company. Well, guess what?
He wasn't.
Yeah, until he wasn't. And those things are really difficult. As difficult as Microsoft, went from an on-prem company to a cloud company, I really think Salesforce is going to have a hard time going hybrid, because there are a lot of things you have to do that are different when you're talking about a hybrid model. You can't drop a software update every 12 days in on-prem. It just doesn't work like that. You have to find a happy medium of changes. There's also a lot of data wrangling that needs to be done as well. And given by the lack of information out from the company on both Tableau and MuleSoft, I have to jump to the conclusion that maybe they're having some challenges.
Yeah, there wasn't a lot of discussion of those two technologies. I think there's some existing customer spend that's probably there, but I would have imagined if the growth was off the charts, we would have heard about it.
Yeah, think about that, $23 billion in acquisitions. But we're not going to talk about it.
Yeah, well, I mean, and that's what I said. Like, at least with like Red Hat, where we were like, that was a lot of money. One of their big growth areas right now is Red Hat. But Pat, I mean, I wrote on Market Watch, I basically eviscerated Salesforce after that acquisition, because I think that was the moment the company lost its way. Even more so than with MuleSoft, was making such a tremendously large investment in a company that did not fit its operating model whatsoever. But you know what, Pat? We're just going to have to wait and see.
Can I add one more comment?
I know. Go for it, dude.
Gotta move. Benioff and Salesforce, they went silent. Like we've got this line of companies we've written about where they've helped their customers and communities with COVID-19. Where has Salesforce been? I mean, did they just decide to take a few months off and collect their pay? Are they being silent because they just don't want to talk about it and they think that aggrandizing helping customers is a bad thing? I've never heard Benioff ever have a hard time talking about how great his company is. I don't know.
Yeah, there was some of that, Pat. So okay. I think we need to dig into it. And again, you and I spent so much time and so many AR teams that were very active in making sure that guys like us knew what was up. I don't think we heard a lot from Salesforce, but he did have his whole work.com, which is basically this whole platform for returning safely to work. And Benioff did get a lot of credit. I don't know if it was deserved individually for making the whole let's keep everyone employed for the next 90 days. That was sort of Benioff's thing when COVID first became a big, but as a whole, when you talk about like Cisco doing $250 million, you talk about massive resources and compute and AI being delivered by other companies.
Amazon hiring 175,000 people.
Yeah, it did seem like it was a little quiet, one that's usually so outspoken. So, yeah, I definitely think that's one of those things. I think it's going to follow companies for a while. The companies that were quiet, that may end up coming back a little bit. So we'll have to watch that, Pat. That's a good observation. So let's talk about something that wasn't earnings real quickly before we can talk about some more earnings. But let's talk about Qualcomm. And, it's a company we like to talk about. Let's talk about something we don't talk about with Qualcomm a lot, and that's Wi-Fi. This last week, Qualcomm actually announced a couple of big launches in its new Wi-Fi 6E, which was expanded. They expanded the 6 gigahertz spectrum a little bit, and the company came out with two new products. It came out with a Fast Connect product that essentially is going to be integrated into the Snapdragon chips. Two different series that can go up to 3.6 gigabytes per second and allow basically phones multimodally to operate in between WAN and LAN to deliver super high speeds on our devices. And, I think of tons of applications for this. You're in a stadium again someday soon, I hope, and you're with 65,000 screaming fans and you want to be able to order that nachos and a beer down to your seat, that kind of technology that we're heading towards, or you want to be able to experience an augmented reality replay of a great moment in a sporting event. It's really hard to get great WAN inside a stadium or inside of a large mall or in a school. Throughout this whole process, Pat, throughout this whole work from home thing, my Wi-Fi has been my demise. I mean, I've got Wi-Fi, I've got mesh, I've got all this stuff. You know what I ended up having to do is I ended up having to run cable by a managed Ethernet switch and make sure I was connected all the time, because Wi-Fi just isn't good enough a lot of the times. And so this enhanced connectivity and this new wider, you can call it highway, right? You've just taken a 1-lane road into Austin and turned it into a 3-lane road. And by the way, Austin needs to expand its highway system. Side note, anyway. And so that's really positive. And so on top of this Fast Connect, though, Pat, the company also expanded its Networking Pro series, because if you want to be able to use this, you actually need the chips in the routers. And so they built a whole series from home to stadium of routers, and I think there's like 4 different models for different environments. But I think this is a really interesting play, building out this infrastructure that suddenly brings Qualcomm and its technology into every home on something other than a phone. And the fact is I do believe, much like cloud, the future is hybrid. I think when it comes to connectivity, the future is also hybrid. We're not going to want to be dependent all the time on narrowband 5G. We're going to want sub-6. We're going to want millimeter wave. Sometimes we're going to need advanced LTE. And in a lot of cases, like I said, in our offices, we might even need 5G and Wi-Fi 6 to work interoperably, where that Wi-Fi, the 5G comes into the building and then Wi-Fi 6 distributes it. So Qualcomm's developing some really important products. But I think the reason I really wanted to point this out was it goes beyond the mobile device, which is where so much of the energy goes for the company. But they're doing a lot of interesting things in networking as well. Pat, I know you've got a weigh in on this one.
Yeah, I mean, listen, Daniel, you gave a very good analysis on what they're doing and why it's important. I think what I want to do is bring in the competitive angle here, which is Broadcom. So before mesh Wi-Fi came on the scene, Qualcomm had almost no market share in Wi-Fi chips in routers. And then they came onto the scene with mesh Wi-Fi and did what I always knew could happen, is they increased the ASP of a consumer router. And they did it with innovative companies like Google, as an example. And every mesh Wi-Fi unit that you see in the channel right now is based on Qualcomm technology. Their competitor Broadcom literally can't figure it out. And what I see competitively for Qualcomm is the opportunity to start running up the score against Broadcom, because this is an area of big strength for Broadcom. And, Daniel, as you and I have researched for a long time, Broadcom doesn't like to invest money in research. Once the IP is sitting there, sure, they'll go take it and make a chip out of it. But it's typically, they're always going to be late to the party. And this I see this as the opportunity for, I don't want to call it paybacks, but, after, Qualcomm essentially stole 25 points of market share in Wi-Fi from Broadcom, I think that maybe they want 50 or maybe they want 60 now.
Yeah, well, it's a step in the right direction. I mean, you could see why Broadcom wanted to buy Qualcomm. There was a lot of benefits that would have come into the company. But I was steadfast during that time. I'm steadfast now. It was not for the best for the global pace of innovation for that acquisition to happen. And I'm glad that the decision was made to not allow that. But personal feelings aside, Pat, we got to keep moving on to our last topic here. HP, Pat, HP earnings. I promised you earlier when we talked about Dell, another provider of tech laptops and computers and 3D printing technologies, reported their earnings as well. What was your take there?
Yeah, so this was another company that was poised to take advantage of the work from home phenomena. I think the big challenge here was they had supply chain issues. They just couldn't get parts. Demand for PCs and ink was high. The channel was clean, but it just couldn't be fulfilled. So in the context of COVID-19 and people working, doing school and governing from home, they did well. They just didn't do as well as some of their competitors with larger supply chain. I am pleased to see that they do have a sizable notebook backlog that their CEO, Enrique Lores, told me on the phone would be fulfilled in Q3 and is not going to be lost. They did say that early May, their supply chain is fully online, so at least half of their quarter won't get hit. I was very, very happy, and again, this is a little bit less industry analyst and more financial analysts. They did hit their EPS targets, even though they came up short on revenue, which I attribute to very successful cost containment, indicating that it's delivering on its cost containment plans it had announced last year. So there we have it, Daniel. Short.
Yeah, that's an interesting one, Pat. And I didn't have a chance to monitor close. So I heard a little bit of negativity that came out of the back end of that earnings. And that was that related to the backlog, or sorry, not the backlog, kind of the guidance being a little softer now that it had its big work from home explosion?
Yeah, and it was the question on Inc. A lot of the profitability that HP derives are profits from Inc. from companies. And with people not going into work, that high profit, high revenue isn't happening. Now, on the flip side, their consumer printing as a service skyrocketed, right? So people who weren't working at work and printing from work were printing at home. They just didn't print as much to make up for the downfall in enterprise printing.
Got it. Yep, that makes a ton of sense. So, I think HP's had a challenging run, but I think the company has a future. I've been really impressed with some of the progress the company's made. Some of its most recent notebooks. I've been using a couple of their different products this year, and I've used the Envy. Really liked it. Been very satisfied. I just mean the quality, the manufacturing, the look, the feel of the brand has come a long way. I also think an area that the company has some real sizable opportunities has been in additive manufacturing and 3D printing.
Absolutely stellar.
Has some really strong positions there, and the company needs to keep touting that. We know Alex Cho, who runs the personal compute business pretty well, and Enrique, who used to run the print business, is now CEO of the company. I think that the company was able to deflect off Xerox's overtures. That would have been a real waste of a merger. Glad that didn't happen. But it's definitely going to have to put its head down, find differentiation, find scale, find growth to become exciting again. That's really I think that's the story around all things HP and HP's past right now. But rooting for these historic companies to see the good things in the future, Pat, and that was some great analysis. So with that, we were a little long-winded today, Pat. We do that sometimes, don't we? We should call it the 6, 5.5 because, we just can't seem to do 5. We're like 5 minutes and 30 seconds per topic. Plus our introduction, our outroduction, and we like to chat. But hopefully everybody out there had fun with this show. We really appreciate the community. We appreciate everybody that tunes in, sticks with us week in and week out. If you like what you hear, we ask that you hit that subscribe button. We ask that you jump into Apple Podcasts and give us a 5-star. Give us a review. Share us out there in Twitter, or shoot us a note at 65 Podcast. Talk to us. What do you want to hear about in tech that we could talk about? All those things are in your control. We do read our Twitters. We do follow our social medias. Hit us on those channels. But for now, we got to go. We'll see you very soon on an episode of the 65 Podcast. Bye, man. Now.